I want to begin as the moderator with just a few framing remarks, and then we'll just go around the panel, starting with Simon Lewis. I think what we've heard in the earlier sessions today suggests that even though some shock absorbers have been added to the system, the business model of the financial industry has not really changed in a fundamental way. The lion's share of profits are still made by trading and market making. There's still a reliance on relatively short-term finance. There's still the risk of a run in a crisis, and while, as you heard from Sheila Bair, resolution authority is well on its way, we don't know finally how it would perform in the event of another meltdown. And although we do know that higher capital standards would help create circumstances where we would never need to use resolution authority, we're not there yet on that front either. So the question we want to pose at this session, more in political economy or political science terms, is why this is the case. Why is the story of reform after the crash of 2007, 2008 so different from the story of reform after the crash of 1929 and the reforms that began in 1933, where one of the political consequences of the crash was really to transform the nature of the financial industry, a set of reforms which really held for 40 or 50 years before the industry reverted to more of an idealized free market, with results that we saw in 2007, 2008. What are the vectors of influence? What are the dynamics of the democratic deficit such that the financial industry has quite exceptional influence over the decision-making process, and groups like Finance Watch or Better Markets or Americans for Financial Reform are outgunned by 100 to 1 or 1,000 to 1 or more in the highly technical process of rulemaking, evaluating proposals, making comment on proposals, getting access to decision makers. So with that rather biased framing, although I think it's one that's borne out empirically, each of the panel will talk for 5 minutes or so, and then we'll have an open discussion. So to begin, Simon Lewis, the CEO of AFME.
Thank you, Bob, and good afternoon, everyone. I am delighted to take part in this panel today, and perhaps I could start by congratulating Thierry and his team at Finance Watch. I think you have done a great job in the time that you have been running Finance Watch, and it's a pleasure to be here and to be part of this wider conversation. I do feel, for full transparency, however, I have to declare that we actually share office space on the same floor in Brussels, and so far all we've shared is the coffee machine, the photocopier, so just for transparency. But yeah, Bob, is it nothing else? No. Bob, as you said, this is a crucial issue, where we are with reform. It matters for the effectiveness and the legitimacy of the financial system. I thought the way I'd approach this is to look at it through the prism of Basel III, which has been an incredibly important part of the response to the crisis. You could almost describe it as a laboratory to test some of the principles that have been discussed today. So I'll start with our assessment of the balance sheet, as you might say, on financial reform in the period since the crisis. And I would say, on the substance, there's been significant progress. There is a regular assessment from the FSB. The latest one was in September, which is a kind of annual scorecard on the implementation of the financial reforms by the G20. Includes a rather formal letter from Governor Carney. The scorecard was published in September. What does it tell us? Well, broadly, that there's been progress on the key reforms that we've heard about. They're well advanced at global level. Much of the work on the rules is already complete. There are even traffic lights to prove that, green, red, and amber. But obviously at national and regional level, work is generally far less advanced, and I think that's an important theme. So that's the case for resolution, shadow banking, and as we heard this morning, the very interesting session on derivatives in that piece as well. But I guess the progress of regulation isn't the only measure of reform. There's a lot of work that we, the industry, have to do and have been doing. We've got to de-risk, we have to restructure our business model, and we've got to anticipate the general trend of regulation. And I have to say, so far, this has been a long and hard and painful process. It's been the right thing to do, but it has been not without its challenges. So what have we achieved? Well, we have a system which is obviously much safer than 5 years ago. It's much better understood. Do we yet have the restoration of the trust in the industry that was foregone in the crisis? Absolutely not. And that's, I think, where a huge amount of work is required. So maybe just to dig a little deeper on Basel III, which you could argue is probably the single most important element of the regulatory response to the crisis so far. The G20 in Pittsburgh in 2009 was the place where the main principles were set. I remember it very well. I was there with Prime Minister Brown, and as befits the UK press, despite the fact that Pittsburgh was about the major changes in the financial crisis, the post-financial crisis, the only thing the UK press were interested in was whether Prime Minister Brown was going to have a bilateral with President Obama, which he didn't manage to achieve in the end, but that was the only story that the UK press wrote about, but I make that as an aside. So there was a mandate from Pittsburgh that was handed down to the Basel Committee. So in Europe, we've seen that obviously enshrined through the CRD4 text, which was published in 2011. And then the package, the fundamental package, was agreed in June this year by the Parliament and Council of Ministers. But many of the implementing measures are still being developed by the EBA. There's some national discretion on the implementation of the directive, and obviously the EBA has quite a lot of flexibility in how it writes the detailed rules. So obviously we wait now for the main elements to come into force in January of next year. So that's the story so far on Basel III. What does it tell us about the reform process? Well, first, and pretty obviously, there are multiple levels of decision-making. The G20 is a global political forum which meets irregularly. The Basel Committee is a technical body with a global mandate. It comprises, when you can find it if you visit the website, mainly senior and unelected officials from the central banks and treasuries of the world's largest economies. The EU clearly has both political institutions and technical regulatory bodies. And I have to say, Sharon and her colleagues in the European Parliament have played an incredibly important role in the reform process over the last 5 years. And clearly there's an important role for the member states as well. So far, so complicated. But we are, and this is a really important feature, I think, of what we're addressing, we're having to deal with imperfect decision-making structures. So although the agreement of the G20 was a major advance, neither the G20 nor the Basel Committee, to which it delegates the rulemaking, actually has any means of enforcing consistency of its members or indeed compliance. So, for instance, there are a couple of countries at least who've yet to implement Basel III. I think Governor Carney named and shamed Turkey and Indonesia in his September letter. And indeed, where Basel is being implemented, there are wide differences in interpretation at national level. So how do we feel about that? Well, what do we make of the fact that by choice Switzerland is imposing a higher capital ratio, the so-called Swiss finish, on domestic banks? The decision by US policymakers, as we've heard today, to impose standalone capital and liquidity standards on foreign banks in its jurisdiction. The decision by the UK government, through the Vickers proposals, to separate retail banking operations from investment banking operations, or indeed, again, as we've heard today, the prospect of further structural change in Europe through the Liikanen proposals. Is this democratizing the reform process? Is this individual countries responding to the public views and the public concerns in different markets? Or is it actually democratization and democracy getting too involved in the reform process? So, to conclude my sort of initial remarks, from the industry's viewpoint, from AFME's viewpoint, we see widely differing standards, possibly increasing costs and presenting big operational challenges. But actually the Basel model does provide some interesting safeguards, in particular certainly attempting to set global rules allows regulators to pool ideas and agree on the best solutions. It limits the power of so-called national champions to weight the rules in their favour, and this is really important. It actually prevents countries from engaging in a race to the bottom in terms of regulation. So if anything, the experience in Basel III, in my view, suggests the opposite, that countries are actually competing to create the safest and best capitalised banking system, and I'm sure there are many people here who would welcome that. So, in a way, the Basel process exemplifies some of the key tensions in the policy process that we've heard during today. There's the desire for strong, effective global rules, and the perfectly reasonable demand by governments and citizens for diversity, safety, and control at national level. And that's the fundamental tension, I think, in not just the first 5 years of the reform program, but what we need to think about as we go forward. So I guess that's probably the right moment for me to pause and to hand over to other members of the panel.
Thank you very much. Professor Walter Mattli from Oxford.
Thank you. I would like to step away from finance for a minute and ask a very general question, which is, what lessons can the history of regulation teach us about the conditions under which reform is more likely to succeed than not? Now, reform across all sectors of the economy is always reactive, not proactive. It responds to a big crisis, scandal, accident, disasters. And there are plenty of examples of attempts to overhaul a dysfunctional regulatory system. Yet, a simple first historical fact is that effective or successful regulatory change is relatively rare. There are many more cases of failed reform than success. Second, even successful cases tend to be highly protracted affairs, sometimes taking decades. And part of the reason is that the process of reform has multiple stages, each of which may take a long time. First, the agenda-setting stage, then the negotiation stage, during which legislation is produced. Then comes the implementation stage, resulting in detailed rules. Then the monitoring stage, the putting in place of an effective system of monitoring compliance with the new rules. And finally, the enforcement stage. Without effective enforcement, reforms will not succeed. I recently talked to a CFTC commissioner. I asked him, what resources do you have to enforce your new rules? He said, none. That's the problem. The third historical fact is that this is trivial somewhat, regulatory change produces winners and losers, and potential losers will fight at each of the 5 stages to try to slow down or kill the process of reform. And sometimes potential losers are very powerful economically. Think of the tobacco industry, the pharmaceutical, chemical, car, and steel industries at various moments in history. Now, we all know that the financial sector has grown by leaps and bounds over the last 3 decades by any measure, and today is a dominant sector of the modern economy. And there's nothing wrong with economic dominance. This may simply be the result of a very effective or successful business model. But economic dominance must not be allowed to become politically predominant. Historically, where industries have become politically predominant, reforms have failed. So what needs to be done to avoid such an outcome in general, and specifically in the context of financial reform? My answer, based again on an analysis of the historical record, is actually very simple. Failure can be avoided by invigorating 2 fundamental principles of democracy. First, robust institutional checks and balances, broadly conceived. And second, solid political or societal checks and balances. Let me take just 2 minutes to elaborate and conclude. Institutional checks and balances comprise transparency in rulemaking, proper due process, accountability and oversight, and perhaps most critically, fair and equal access as early as the agenda-setting stage for all major stakeholders in society. I was struck by a recent comment by Richard Rayburn, who was in this room and talked to us earlier today, chairman of the European Association of Corporate Treasurers. He complained about the Commission being over-lobbied by the financial sector. So much so that, quote, he said, fatigued drafters of regulation closed their door on other representatives. And he goes on to say, quote, we require a form of affirmative action on the part of the European Commission to ensure that access is allowed even if the requests are later than those made by the better-funded financial sector lobby. Now, if Rayburn and his members have access problems, just imagine what the difficulties must be for consumer groups and other little guys. Huge. Any solutions? Well, yes, there are solutions, and in fact, very interesting solutions developed, for example, in insurance regulation in the United States, including proxy advocacy, trilateralism, and various forms of consumer empowerment. There are really interesting lessons to be learned from other areas of regulation. Finally, political or societal checks and balances. History shows that the chances of successful reform grows with the emergence of pro-change alliances of so-called strange bedfellows. These alliances typically comprise consumer groups and other little guys, and critically, big corporations, or those parts of a targeted industry that actually welcome new regulation because it opens new business opportunities. Think of the success, recent success of US consumer groups allied with big corporations such as Walmart and Home Depot in the fight with Visa, MasterCard, and credit card banks over swipe fees. Or think of companies such as Bloomberg or TradeWeb pushing important parts of derivatives regulation with others because it will enable them to enter lucrative new businesses. The point is, the financial industry is not homogeneous. There are sometimes deep divisions, important differences in preferences over proposed rules. So one recommendation, somewhat far-fetched you may think, is for public officials or private sector entrepreneurs to establish and support matchmaking schemes or mechanisms that facilitate the emergence of alliances of strange bedfellow, thereby enabling a much more balanced interest representation in rulemaking. Concluding note, democracy cannot be taken for granted. It must evolve to deal with new challenges and fit new realities on the ground to remain functional and effective. And nowhere is this more pressing, in my view, than in a context of financial regulatory reform.
Thank you very much. Next is Bob Jenkins, the former member of the Bank of a former member of the Bank of England's Financial Policy Committee.
Thank you. Right. Well, good evening. Good afternoon. I would also like to start with Basel, but perhaps with a slightly different slant. We are all working our way through the greatest credit bubble in history. Now, bubbles are not new. They're always the same. They're always a little bit different. They all feature heavy doses of greed and stupidity and leverage. Now, what distinguishes the most recent bubble from all past is the degree and magnitude of leverage. Now, we are not going to abolish greed, and we will not outlaw stupidity, but we can and must do something about excessive leverage. We may or may not be making progress towards the endpoint of Basel III, but Basel III's endpoint does not make any significant reduction in excessive leverage. Two areas of an example, risk-weighted assets. We had a lecture on it this morning. There's no need to cover the same ground. We heard that the risk-weighted asset approach is gamed, manipulated, or the subject of misjudgment. But even if the Basel standard risk weights were applied, even if the use of own models to calculate risk was abolished. You would be left depending on the judgment of the regulators, who clearly got it wrong the last time around. Take an example, the famous CDO squared. How much loss-absorbing capital do you think Basel II required for the support of 100 euros of CDOs squared? A security, backed by a security, backed by a pool of mortgages to subprime US homeowners. Oh, and assume that it was rated AAA by the credit experts of the day. Well, Basel II required 40 cents for every 100 euros of exposure. Of course, we're a lot smarter now. What does the Basel III rules require? €1.35 for every 100 euros of exposure for a security that neither rating agency, investor, banker, or regulator could correctly price. That's the risk-weighted asset approach, which is one of the key pillars of the leverage controls going forward. The second is the leverage ratio. We've heard a lot about it. Suffice it to say that the new Basel rules will enshrine permission to borrow for every 100 euros of balance sheet to fund it with 97 euros of borrowing and only 3 euros of loss-absorbing equity. I don't think that's progress. And in the next session, I guess after this introduction, we'll talk about why we have made so little progress. Thank you.
Thank you. And to wrap up the opening round of comments, Sharon Bowles, MEP, Chair of the European Parliament's ECON Committee.
Thank you very much. I'm sort of overwhelmed with so many different starting places, but given what's gone before, I think that we have to acknowledge that there is a regulatory political gap. This is about democracy. Well, okay. As a result of the financial crisis, what happened in terms of democracy? I'll tell you what happened. It's that very many members of parliament lost their seats throughout Europe. Governments fell. The regulators who had been in charge of making those rules that we've just heard a critique of don't seem to have fallen in large numbers. And therefore, can you actually say that it's right that you want everything to be done in a technical committee where there is no democracy, where there's no comeback on them if they get it wrong? So what did we have? We had G20, which was a political process that set the ball rolling, and I'll return to that. Then you had the technical process in Basel. We have on the market side, we're growing the equivalent, let's say, in IOSCO ultimately. In Europe, in order to make it work, you then have the political bit at the end because you have to enact it. In most countries, you have to enact it somehow. We happen to have to do it in a more detailed way. And guess what? Politicians fiddle around with it. I'm actually quite proud of the fact that I messed around with risk weighting on trade finance, because I actually think it was the right thing to do. The Basel Committee was too strict, and I think I know quite a lot of important people who are at central banks and elsewhere who actually agree with me. I'll spare their blushes. But actually, the Basel apparatus is trying to be bully Basel and make sure that everybody does everything exactly the same. And you know, guess what? Our countries are not the same. So you actually, for all the best will in the world, there are quite a lot of mistakes that have been made by the Basel Committee that need to be rectified. An awful lot of the things that they have proposed do not work unless you have the active kind of CDS market that you've got in the United States. So you end up using proxies of proxies in order to do your CVA charge. It absolutely doesn't work in Europe. Don't know what our regulators were doing around that table. They're either having little pot shots about institutions traditional protection schemes or zero-risk sovereign debt or anything other than what really went on in European markets. So I think there are flaws that go on in these committees, and from time to time, somebody somewhere has to stick their head above the parapet and talk about it. Alas, it only seems to be me, but hopefully somebody else will do it from time to time as well. So we've got a problem. If I go back to G20, I think they made the problem worse because with the best of intentions in what was the focus at the time, which was CDOs and derivatives, there was this panic, we've got to do something about derivatives, we've got to shove up the amount of capital so that, and it really doesn't make a lot of sense, twice nothing is nothing in terms of capital, as you've basically just said. So what they should have done, and I'm proud of the fact that the European Parliament, right from the start, put their finger on this, the first thing they should have been doing is looking at how on earth do you resolve a bank. We had the too big to fail, we knew about it, we had banks going under, and what have we done? We've done all of this complex regulation, and at the end we think, oh, let's work out how we're going to resolve the banks, and actually that then causes you to review a lot of things a lot more sensibly. How are you going to resolve it? Where are the division lines? What do you want to ring fence? Where do you need the capital? What do you have to bail in? Have you got the right instruments? All those kinds of things. I'd quite like now to go back and start all the financial legislation all over again in the light of the wisdom of having us finally got to grips with what we're doing on resolution. Of course, we're not doing that. So, we just have done things so fast that we have not been able to pause to think. It's been, have you ticked the box? How many pieces of legislation have you done? And when it comes to how democratic is it when we're doing our legislation, in the Parliament, we have had to do so much. We have had probably a third of the number of discussions on big pieces of legislation that we managed to have in the last debate, in the last mandate, where we had less to do. Things move so fast that it disappears from visibility in meetings of shadows and then almost straight from that to a quick vote and then into the opacity of a trialogue. Now, I've tried to break with this tradition by, posting on my website a sort of exposure draft of a report I'm doing on benchmarks, but it's a serious problem. I mean, I don't know. I'm not afraid of the lobbyists. They can never get to see me. I mean, if anybody can find 5 minutes in my diary, they're welcome to have it. But it's not there. And I don't think that it's right to say that big business and lobbying is the problem. The Parliament's actually very good at listening to consumers. I think we're very good at bringing forward those things. I don't think there is any preference given, or if there is, it's probably to the consumer bodies over and above those that are industry bodies. But we need the information, and you have to assume that one's got a brain and that you can take from all sides and work out where to go. So I'm not one of those that says that it's all the fault of the lobbyists. I think that we are where we are because the regulators have made things so darn complex, and then you can game the rules. Of course you can. Two biggest asset classes, mortgages and zero-risk sovereign debt. That's absolutely nothing to do actually with the banks, the risk weights on those. It's politics. So, we're all in it together. We actually should have things that are simpler. We should make sure that there's what I would call a sort of corporate governance buffer, that financial institutions don't think it's in their best interests to game the rules. If these are the rules, they should want to stay within them. It's a bit like being a dominant company where you suddenly, the fear of breaking the rules is so great you'll stay well within them. Now, the United States has coincidentally managed to put most banks in that situation now with the suspended prosecutions, that if they transgress, then they're for the high jump. Well, I think we could actually formalise this in a rather better way than using that kind of judicial system, so that actually the risk of transgression and of gaming is so big that you don't want to do it. I'll stop there, but that's a few ragbags of controversial ideas for you.
Let me pick up on one of those and ask a couple of other people to comment on it. It seems to me that the regulators do take the fall, but in many respects, it's the complexity of the financial system that has evolved that makes it too complicated to regulate in a transparent way. And if you go back to the period before all of the fancy stuff was invented, the system was simpler, it was less vulnerable to opacity, and thereby was easy to regulate. I wonder if there is something inherent about the complexity of modern finance, compounded by the fact that you're trying to regulate it globally, where you don't have global citizenship, you don't have a global democracy, that really defeats the ideal of policy being accountable to regular people. It's complicated, it's at several removes from ordinary politics. There's so much money to be made that the industry naturally exercises more influence than the average person. Walter, do you want to take a whack at some version of that?
Sam, do you want to start?
Well, look, you're right. Obviously, the now infamous G20 principles, I think, were pretty robust and sound, and that was 2009. They've been taken, they've been applied in Europe, they've been applied in the US. I'm not sure whether they've been applied in Asia, but maybe in 2009, not a huge amount of thought was necessary, and I can understand why, given to how the application of those principles was going to differ in different parts of the world. And yes, regulators regularly talk, yes, there's coordination, yes, there's a will to do the right thing, but somewhere between G20 and the national and supranational regulators, it seems though there's a piece missing. What is the securities equivalent of the G20? Could IOSCO potentially become something more like the Basel process? I'm sure this is the piece, and we need to have a conversation about this in a way that we need as an industry and other stakeholders to think about. If a quintessentially global industry, which it is to continue to flourish post the crisis, how do we add in a level and layer of global regulatory coordination that doesn't, to Sharon's point, simply rely on a political gathering once or twice a year through the G20? I'm not sure there's a very easy answer.
Someone else want to take a stab at that?
Well, the issue of complexity, it is often said that finance is now particularly complex, so difficult to regulate. You need to have the experts, and the expertise is in the market. But when I started reading up on insurance regulation or insurance and pharmaceutical industries, there's a lot of complexity in these areas as well. I actually don't think that finance is so uniquely complex. Not at all. If you want to really understand issues meaningfully and write good rules, you need to be the expert. And in insurance, pharmaceutical industries, the problem is always the same, and very similar to the one that we have in finance. Huge asymmetric distribution in knowledge and the resources to be meaningfully involved in rulemaking. And so for me, the difficulty really is to draw in other societal stakeholders when the rules are really shaped in a meaningful way, in a detailed way. And that is oftentimes at the implementation stage, which is typically a national process. And some sectors have been very successful in bringing other stakeholders into the game early on. But I don't think that finance or financial regulation has been particularly successful now. I talk to consumer groups here in Europe. This is a stakeholder group associated with the new regulatory authorities at level 2. And they always complain about the same things. Access, no resources, it's the same sort of complaint. And I think these things ought to be addressed.
But the beauty of Glass-Steagall, to pick an example, is that it was simplicity itself. You were either a commercial bank or you were an investment bank, and so a whole huge category of regulatory determinations, lobbying, gaming, just didn't exist. It was as clean a bright line as there could be. So I think even though a lot of this stuff is inherently complicated, simpler is better, and there are ways to simplify, and a lot of the rent-seeking occurs within the complexity and the opacity. Did you want to? Sorry. Go ahead.
Oh, well, right. I'm sure simpler is better, and that if you don't understand it, you probably shouldn't allow it to happen, even under Basel II. Pillar 2 said that if regulators thought something was complex or didn't understand it, they should put more capital on, and that was grossly not applied anywhere. But I've got another little beef, and that's accounting standards. I'm not sure that we had our current accounting standards at the time of Glass-Steagall. And if you have balance sheets that you can't understand, you have accounting standards that allow you to reach forward into the future and pull back profits to the present, which is what is done on so many things. You create the kind of the need for a credit bubble from which you cannot escape, because you've got to keep eating tomorrow's meal today, and eventually you run out, and then you have a famine period, and that's that's why we're in a growth famine at the moment. But we have balance sheets that you can't understand, and we have auditors that aren't actually prepared to sign off the firms that they audit as going concerns because they don't want the liability. I somehow think that is wrong. That if you aren't the auditors supposed to understand complexity and be the experts? We slightly addressed this in the recent changes to the audit directive, but I mean that was the situation that we had, and that has to be addressed. And it has to go back to the fact that ultimately people have to be able to have liability for things, because otherwise they think it's not going to come back on them. And so auditors have got to sign off as a going concern, which means they've got to be able to understand it, which means that you can't have such fancy, nefarious accounting, which means you might actually get a bank balance sheet that an investor can actually understand and work out whether they should be investing in this bank or that bank, and not have to rely on complex derivative ideas like ratings.
Well, I think you can fight the battle at the level of the actual regulation, or you can fight the battle at the level of the structure of the financial system that you're aiming for. I think you could argue persuasively that the tidal wave of regulation, in a way, is a response to the fact that we have ducked the issue of the structure of the financial system and what we should actually try and achieve. And it's going to get worse and worse and worse. It's taking on a life of its own. The only thing that I'm really sympathetic with the bank lobby is that there's too many regulations. The difference I have with them is that I think they're not going to do any good, and they think they're going to be costly. At the top, you need more capital. And where the lobbying and the intellectual capture has succeeded beyond their wildest imaginations is to have convinced the body politic, possibly at the G20 level, possibly at the Downing Street level, certainly very pernicious at very senior decision-making levels. They've convinced policymakers, pundits, and even practitioners that we have to choose, that society has to choose between safety and growth, that we have to choose between safe banks and shareholder value, and that we have to choose between a safe banking system and a competitive financial marketplace championed by the national host. And each of these have been propagated so effectively that they have influenced and effectively defeated the whole point of reform. So the fact that we have to choose, the notion that we have to choose between safety and growth, you've heard it before, you'll hear it again. If you force us to have more capital, we will have to cut back lending. That will retard the economic recovery, and it will be all your fault. You've all heard that. Do the math. A bank has a €1 trillion balance sheet, funded with 50 billion euros of equity and 950 billion euros of debt. Now come along and the regulator says double your equity to 100 and retire 50 of debt. You've doubled your capital requirement. Has the balance sheet shrunk? No. Have you had to cut back on credit? No. Has society had to choose between safety and growth? No. But the banks have persuaded the body politic that cutting back on credit will be a consequence of safer banks. And if you want to be elected, if you want to do what's right for your electorate and get the economy going, it's a very, very awkward situation to be in. The second one is you have to choose between shareholder value and safer banks. The banks tell me, Bob, you've got it all wrong. If you double capital, you'll reduce profitability of the banks. That will reduce returns to shareholders. Shareholders will have less appetite for bank shares. That will cut off the supply of capital to the banking system, and that will reduce the amount of lending in the system. Well, if you define profitability and shareholder value in terms of return on equity, that might be true. Banks targeted double-digit return on equity. Was that a good measure of profitability? Did that produce sustainable shareholder value? Certainly, less equity with the same return produces a higher return on equity. But as Sheila Bair just announced, the 4 largest banks didn't do very well for their shareholders. Return on equity for long periods of time was very high. But the problem with return on equity is it doesn't adjust for risk. The returns come now, and the related bonuses, but the risks come later, and later came recently. Moreover, investors are getting a little bit smarter. They are interested in risk-adjusted return on equity. Investors buy gilts. They hardly yield anything at all, but they accept the lower yield because of the lower risk. There was a time when Citibank shares were held in every single pension fund in the world because they paid a dependable dividend that seemed to be competitive with the risk that you were taking. The more risk in the balance sheet, the more return the investor will require. The less risk in the balance sheet, the lower the return that the investor will require. Capital will flow in either case, but the cost will be different. The risk-adjusted return will be more or less the same. So banks can have lower ROE with lower risk and produce the same shareholder value with a higher multiple. So you do not have to choose between safety and shareholder value. And the consequence of that is the third one. If your banks are profitable, if your banking system is more stable, why wouldn't your banking system be more competitive? Why wouldn't a highly stable, well-capitalized London be able to compete with an unstable, less capitalized New York? So these are the 3 myths. They've been wonderfully propagated. They've been swallowed hook, line, and sinker by almost every key decision maker who either believe it or don't want to take the chance that it's wrong. And the result is that we are celebrating steps towards a 3 or 4% leverage ratio, when we should be looking at 16 or 20%.
I hate to have the temerity.
Simon.
Well, no, I wouldn't have the temerity to argue with Bob's fundamental analysis. I do think that the issue about bank lending in Europe, and we've done a piece of work on this recently, is actually kind of the opposite of what you said, in that there's an over-reliance on bank lending in Europe. Mm-hmm. And actually what we hear from people who are customers of our members is that actually people want other forms of finance. So the logic of what you said doesn't quite work, because actually what we probably need to do is to open up the capital markets in Europe to enable businesses to be funded in the sorts of ways they are funded in the US, private placement market, high yield activity. So there may be a perception that businesses are not being financed through banks, but the reality is, the message we hear, and is coming back to us, is that actually there's an over-reliance on bank financing in Europe. And we've actually got to really get to an economic growth model that works in Europe, we've got to open up our capital markets, and we've really got to make them as flexible and as fast-moving as they are in somewhere like the States, because otherwise we're going to have the same debate in 5 years' time about why we haven't got sustainable growth in Europe.
Well, I certainly don't disagree with the desirability of broadening, deepening, and opening up the capital markets. And I do acknowledge that Europe is more dependent on bank lending than on securitization. But precisely because of that, a more highly capitalized banking system in Europe would have allowed the banks to take the hits that they needed, would have allowed them to liquidate the loans that are tying up scarce liquidity, but which are being carried on the books because not to do so would take a hit for which they would need capital that they don't have. Sheila Bair said it, Adrian said it this morning, other people have confirmed. Banks that are well capitalized can take the hit and keep lending. Banks that are well capitalized don't have to look over their shoulder and worry about taking a loss on a new loan. Banks that are well capitalized can support economic growth.
Well, I would think that both things are true in the following sense, that there's a need for more innovative capital markets, and because of the overhang of debt, because of the slow growth, because of the imposition of austerity fiscally, there are not good lending opportunities commercially from the perspective of banks, so that yes, you need more innovative capital markets and you need more banks to do more ordinary commercial lending, which is not as exciting, not as remunerative as trying to be like a hedge fund, but it's what banks did in the old days, and it's what banks do less and less now because there's so much more money to be made on the market-making side, on the trading side, et cetera, et cetera. So I guess my question is, we've got a kind of a codependency now between dysfunctional states and dysfunctional banks. And the emblematic case of that is the preferential risk weighting for sovereign debt. And that creates incentives for states to not want to look too hard at banks' banks' books for fear of what they might find and for fear of getting more pressure to do a deeper cleaning, which in turn prolongs the sluggish recovery and reduces democratic confidence in the system. How do you break that loop, given all of the structural fragmentation in Europe, only slightly less so in the United States? I mean, both systems are somewhat dysfunctional, although a la Tolstoy, they're dysfunctional each in its own way. How can you break that loop?
All right, is it me? Okay, right, fine. Well, the big idea in Europe, and I think it actually works everywhere, is partly through bank recovery and resolution. I mean, the big idea was also to have backup funds and all these kinds of things. But I think if you analyse it, the Bank Resolution and Recovery Directive, or internationally the notion that you're going to bail in the bondholders, and the markets are now expecting that, is a huge step. Of course, if you have a big systemic and catastrophic failure in the end, I think we all recognise that probably states will somehow try to rescue certain parts, at least, of the banking system. So the sort of not a penny, not a cent, not a euro more of taxpayer money ever was never going to be likely to be sustained. But you can absorb a lot more before you get there, and so what would have to be put in would be less. Now, if you're looking at it in the European context as well, we're trying to somehow, or it's within the Eurozone, sort of even things up so that the, if you like, poorer countries aren't at a disadvantage to the richer countries by having backup funds that are there and can be drawn on, albeit, you know, with conditions and so forth, but so that one can enjoy somehow collectively the lower rate at which funds can be borrowed, you know, collectively rather than individually. We have to be very careful, I think, as we go forward with the single resolution mechanism, that is what we achieve, and that we don't actually institutionalise bailouts by funds instead of bail-ins, and that we don't always expect, you know, everybody to be paying for the sinner and all this kind of thing. And there are serious dangers of that, but one hopes that proper application of state aid rules to any kind of fund, no matter how it's raised, and there are problems that some things accidentally, if you like, fall outside the state aid net, that we mend those. So I think there are dangers. Of course, everybody, I mean, I've railed about zero risk-weighted sovereign debt for so long, everybody's certainly bored with me about it. It's still the case that in legislation we cannot even manage to get in a recital that hints at it in Omnibus 2. We're now not even, the Parliament's been trying this for quite some time, but the member states won't even allow a murmuration that something might happen. This is actually in Omnibus 2, so it would be on the insurance side to the zero risk weighting of sovereign debt. And I mean, that would have been an obvious one to put it in, because at least you do have certain aspects of mark-to-market going on the insurance side, which you don't on the banking side. So politically, it's at an impasse, and I think it was Europe's doing in the first instance with Basel I. There is still this notion that until you can get the same treatment for every member state, we haven't got a currency union. It's a sort of chicken and egg question that keeps going round and round. So that's the state of play. I'm not terribly optimistic that you can actually, at the end of the day, really, really set aside. But I think bank recovery and resolution and bail-in and making sure that you have got enough to bail in, which of course is the next phase. I think also making sure probably that you have more equity, probably making sure that you don't unfairly prejudice towards debt by tax treatment. All of those things have got a place in trying to rebalance the system, both in terms of more equity and generally how to get things more stable. But it's going to be a long haul to do all of that.
The other piece I was going to say is obviously the quality of supervision. I mean, it's been quite interesting today that banking union hasn't actually been mentioned that much. And in a way, it's the biggest, most significant potential structural change, the way that Europe's banks are supervised, that we've seen in a generation. We're very supportive of it as AFME. We think it's the right thing to do. We think it's going to fundamentally change the way banks are supervised. It's going to be a major step forward. It's going to de-risk a lot of what we've been talking about. But, it's still got to happen. And I think that's the other point about, coming back to the theme of this panel, you've still got to have the political will to actually deliver something as big and as important as banking union. It's probably not enough just to say, well, let's hope the German government's behind it. You've actually got to believe that it can be put in place, and when the ECB goes out and recruits and hires a whole bunch of new supervisory people, they're actually going to be able to do their job because actually the mechanisms are in place. So I think that's another really important part of the completion of the reform process, to get banking union in place with the resolution mechanism alongside it.
Why don't we leave plenty of time for audience questions? So thank you all. The floor is open. It's hard to see. I can't even tell if that's a lady or a gentleman. Yes, you're a gentleman. Stand up, please.
There's a hand.
Walter Zadig from the Institute of New Economic Thinking. So, ethics. I just wanted to know, in a system of values that champions objective wealth maximization, ethics is seen as a kind of a constraint on behavior. Yeah, but this can backfire, of course, and we can actually create a system that is even more unethical. But if we set ethics as a fundamental objective for our endeavors, and especially, and spread it through the financial world, yeah, then we can make ethics a logical goal, and even desirable, a desirable thing. So what I wanted to ask is, how can we reform finance in a way that ethics can become the center of our way of life in general? Thank you very much.
Can I?
Bob?
For ethics to be at the forefront, you have to put the customer higher up in the ranks of the stakeholders of the financial firm. If you think of the financial firms, they serve many stakeholders: executive management, employees, shareholders, customers, communities, society at large, for example. Where do you think those stakeholder groups ranked in 2007? Where do you think they should rank? If you move the customer up, if you embrace as your corporate motto, do what's right for the customer, and he will do what's right for our company, then you can begin to reconcile what I'm sure to a lot of people in the audience seems like your very naive statement. But it can be done, provided you're willing to move the customer up the rank. Then the question is, well, if the customer moves up the rank, does the shareholder move down? Can you reconcile your duty and obligation as an executive to the shareholder with your desire to have a more ethical approach to your customers? And the answer is you can, depending or provided you're willing to measure success for your business over a longer time horizon. In other words, you can build a great enterprise that builds great shareholder value by putting the customer higher up the ranks, provided you're willing to measure that success over a long period of time. You can't do it on a quarterly basis, you can't do it on a yearly basis, and you certainly can't align incentives on a quarterly and yearly basis if you're putting the shareholder not necessarily lower, but if you're putting him behind the customer. If you present a compelling enough proposition, the market should attach a higher market multiple to that enterprise because of its sustainability and its likely success than a firm that is only focused on quarterly earnings should. So I think it can be done, but it's not easy. Great companies that are around today often embraced that attitude. In the investment management industry, T. Rowe Price has just that motto on their door. They were a partnership. They wanted to get rich slowly. They didn't have to get rich quickly.
Well, and I think to the extent that the customer comes last, it's a sign of market failure, because if competitive markets are working, the customer comes first. And I think it was Nicholas Stern who called global climate change history's greatest case of market failure. The meltdown of 07, 08 in finance was probably history's second greatest case. And the customer coming last is emblematic of that. Other thoughts on this, or should we take some more? Questions? Yes. Yes? Yes.
Andreas Watch from the European Trade Union Confederation and a founding member of Finance Watch. I found this debate very fascinating, and I must say I strongly agree with the points that Robert Jenkins was making on the wrong, trade-offs that he was talking about. We in the European Trade Union movement, we believe that a prerequisite for democratizing financial markets, or the reform process of financial markets, can be summarized in a formula that goes with that starts with 5 S's. The 5 prerequisites are that financial markets should be smaller in size, slower in speed, simpler in structure, separated functionally, and I'm cheating with the 5th one, less short-term oriented. And I think that may actually come very close to the debate that you were having on the panel. Now, the problem in talking about market failure and the loss of confidence of European citizens, which is a threat to democracy, which I'm afraid we will see in the outcome of next year's European elections, is that total disconnect between risk and liability that we've seen in particular in the area of finance. And I'm afraid that none of these 5 S's have been achieved so far in 5 years of financial reform.
Let me just turn that into a question. I agree with the sentiment. So, are there things that we could be doing more effectively on the financial reform front that would redeem some faith on the part of the European citizenry in the whole European project?
You have to put some people in jail. You have to put some bodies on the street. And you don't even need new laws to do that. You have to have courage of the regulators to use their powers that are there today. You know, the FSA has the Financial Services Administration in the UK before it was split into 2 new entities, but it was in existence throughout the crisis. There was this notion somehow that you know, they were powerless to act on any individuals for accountability because the laws weren't there for criminal prosecution. But the FSA has a process by which they authorize persons in senior positions in finance. And they also have the ability to withdraw that authorization. They could have withdrawn the authorization for all of the board members of all of the failed banks and all of the board members for the banks that were recklessly managed but didn't fail. They didn't do it. So the issue is not just laws, which is a parliamentary issue. The issue is also the courage to implement the powers that you have in a fair and just way. Somebody's got to go to jail.
Sharon?
Yeah, I think what's been said is very true. I think, unfortunately, from a European perspective, it's also something that has to be done at the member state level because we cannot get the agreement on powers to do with criminal sanctions very easily at the European level. It falls into an area which we're only newly being able to explore, but we have not been able to put penalties as high as we would have liked for administrative sanctions into legislation, because in some member states, once you get an administrative sanction to a certain level, it triggers a criminal prosecution, and of course all the additional complexities that brings, and the time, and and actually lesser chances of success. So it's actually rather aggravating for us in the Parliament. We've gone round the loop on this with CRD4, we've gone round the loop on this with the market abuse regulation, and we're going round the loop again in MiFID, trying to find ways in which we can, make for much stronger penalties, because frankly we're fed up of these sort of stinging, eye-watering penalties in the US, which we wish were happening here, and would give the public that confidence that Europe could be tough. So we've got a problem both on the criminal sanctions side and also on the administrative sanctions side, just not being tough enough.
Questions? Yes. Madam? Yes.
Yes, Anne-Philippe from BUC, the European Consumer Organization. I would like to come back to this issue of access to policymakers for stakeholders. We don't have problem to arrange meetings with this commission. I insist, this commission. It was not the case in the past. I have some doubts for the future. Depends also of the involvement of the commissioner. We have some problems with the parliaments, including to meet rapporteurs in charge of legislative proposals that have a direct impact on consumer interest. I would like to refer to MiFID. I would like to refer to the Insurance Mediation Directive, for example. And now there's the directive on the Payment Services Directive, and the rapporteur has told us that he has no time to meet with consumer organizations in the coming weeks. So I'm sure that in the same time, all those rapporteurs have time to meet with representatives of the financial institutions. So I would like to make a proposal. Why not ask each MEP to publish the list of lobbyists he has met and the list of amendments he has received? Thank you.
Thank you. Walter?
I mean, I really think that, is how do we improve things? What Bob was saying, I mean, some people know these trade-offs, perpetuated trade-offs, are myths. They're not truths. And there's plenty of academic research to show this, right? Why is there nobody talking on behalf of the academic community to regulators? Why is it that so many people with knowledges and different preferences are not part of the discussions? I mean, you know, I think you're exactly right. We need much more transparency, much more transparency. And there are some really good models. I'm hugely impressed by what Gary Gensler has done at the CFTC. When he became chairman, he said, anybody who wants to talk to me or any of my commissioners will have to provide, we're going to be providing a summary of what was discussed. There's going to be a listing of anybody coming to CFTC for talks, right? And that is a useful step. Wall Street didn't like that, but go to the website of the CFTC, everything is there, it's perfectly transparent. And this is a great model. FDIC has done the same thing. But there's so much more work that needs to be done to really introduce and check meaningful transparency. The lobbying registry here at the Commission, I think, is lacking in many ways. There's so much information that is not there about the exact amount of money spent on lobbying, and you know. So I think transparency is key, and that needs to be, you know, pushed much more aggressively. And the other thing, I think it is important to overhaul key transnational rulemaking bodies to empower groups in meaningful ways. You were talking about accounting standards, right? So the IASB is writing IFRSs, and you know, European companies have been following, they're obliged to follow IFRSs since 2005. Now, the board of the IASB had at the time 14 members or 15, now it's 16 or 17. The vast majority of the board members writing these rules were non-European. They represented an Anglo-Saxon tradition of rulemaking. But it's the Europeans who were the first actually to agree to follow these rules. I'm sorry, this is scandalous. If Europeans are committing to following IFRSs, there ought to be reasonable representation of European preferences or interests within the board, right? Consumers, I mean, investors in the end. IASB says, oh, you Europeans don't try to politicize us because we are this community, epistemic community of technical experts who write the best possible rules, right? And we write them for the benefit of investors. Okay, so where are the investors in the rulemaking process? Nowhere. Ask investors how useful these IFRSs are. And they're going to say, we don't understand these rules, they're just too complex. My point is, a lot of these key bodies need to be overhauled. The structure doesn't work, they need to become much more inclusive, much more transparent. And it's a difficult task, because you need to educate stakeholders to be able to speak intelligently about complex issues. But I think that's part of the homework that we ought to be doing.
I think there's quite a lot of... Sorry.
Please.
Well, I just think there's quite a lot of misunderstanding even now as to how decisions are made in Brussels, how deals are negotiated, how something goes from a draft to a super draft, how clauses get inserted, how they don't get inserted. Maybe it's the same in every parliament, but I think as the European Parliament has become more important, I think it's become more difficult for many people to actually really understand what the decision-making process is. Maybe it's never going to be a perfect, to your point about, maybe it's never going to be perfect transparent, but I think there's a challenge for decision-makers and policy-makers as well in terms of helping people to understand them. Obviously, well-resourced organizations can find ways of finding out, but it's the kind of, to the question there, it's kind of getting a bit more of a sense of how the process really delivers the end product that I think would be really helpful for the body politic.
I'd like to come back to something Walter said earlier in his opening remarks. You said that historically, very often, reform makes a leap forward because, coincidentally, by accident, bodies that weren't initially involved in the debate come together for various reasons and then give it new impetus. And there's perhaps an example, Dennis Kelleher can talk about it afterwards for those who are interested. But in the United States, the move by a number of congressmen to raise capital levels gained some new strength because they appealed to the community banks who had been left out of this debate, but who naturally, out of prudence, capitalized themselves at a much higher level and said, why are you silent on this subject? I mean, it's no skin off your nose if we make the system safer by raising capital requirements for the big boys, and by the way, they're going to eat your lunch and they're competing on an unlevel field, so why don't you get into the game? And it's as though it was all of a sudden discovered. I have been working on the investment management community. No part of the financial sector has a greater stake in financial stability than the investment community, and no group has been more silent on the subject. If they were as active collectively as were the banks, it would be a much more balanced debate. The consumers will weigh in inevitably through the election process.
Sure.
Yes, transparency is something that we've worked quite hard at in the committee in various ways. I mean, individual MEPs have got different systems for how much they make public. I mean, I've got a spreadsheet on my website which shows who I meet, also who all my assistants meet, because there's more of that, because I'm usually chairing something and so not available, and generally what it's been about. And in the committee in general, rapporteurs have been very good in various different ways about sharing lobbying documents that they have received. Sometimes it's been on a public website, sometimes it's been on a website that has been accessible just in the Parliament, but we've made sure that for those working on things, sort of everybody has everybody, and that's certainly improved a lot, I think, over my experience in the previous mandate. But unless sort of everybody is prepared to do things, you can't get rules for one committee that isn't done by another committee, and you know, we can't manage to get transparency over what the Secretariat of the Parliament is doing, because they won't sign up to things that aren't the same in others, and that's a bone of contention for some. With regard to how easy it is to get meetings, quite often it depends on when you ask. I mean, the financial institutions perhaps are a little bit more astute, and the moment somebody is likely to be a rapporteur, they're in there with their request, and then those that come along later don't get in. There are also those that have looked at my website and seen that I've met all my staff have met so many people, and therefore they think I have to meet an equal number of people just from one NGO. And I have to say, of all the lobbying that I have received, both in this mandate and the last mandate, the only people I've actually caught lying to me have been NGOs. Because the notion that NGOs are wholly pure, they're out there trying to get their words in. They come with data that is from the United States, not from Europe, and they get cross with you when you ask for Europe data and all this kind of thing. So it's not necessarily, easy. I mean, I think the Parliament as a whole is very sympathetic to trying to meet consumer organisations. But I have to say that I'm not the only person that has necessarily had bad experiences. And we do like to have, well, I certainly like to have position papers up front, but those of you who've tried to get hold of me sometimes will know that I have sent the reply. I have two choices. I can either listen to you, or I can write an amendment that might address your concern. Because, the time constraints on us with the volume of work, probably 50 work streams at any one time. Most of the MEPs who are rapporteur on one thing probably have hundreds of requests to see them. If you're working on benchmarks and you're dealing with commodities, you have a whole load of different types of commodity people that want to come to see you. So you will meet more people perhaps on commodities than you will from consumers. And that's the way it is. It's not that there isn't a lack of interest. I mean, I don't know what individuals are doing. Certainly once we get into the trialogue stage, I just wish people would stop asking to see us, because it's not going to make any difference to the outcome of a trialogue what any lobbyist tells to us. If we perhaps go to somebody in industry because we want to understand the point, and that does happen, and they are a huge educational resource, and guess what? We do go to the buy side, the sell side, and every other side that we can think of with different problems. But once you're in the trialogue, I'm afraid that it is, politically negotiations and hammering out, and what can the council give, what can the parliament give. Meanwhile, the commission's trying to tow it back to where they came from in the first place, that by then the parliament and the council have already decided isn't quite right, maybe sometimes the same way, maybe sometimes differently. And then you're, I'm the only person that is always in every trialogue, and I'm desperately trying to get some kind of things that are the same in different dossiers, and it doesn't work out. I mean, it's not a tidy process, but then neither is the process in the United States when they had to stick Dodd and Frank together. You know, they have a conference, they have to do negotiations. The good thing is they do it in public. I mean, we did accidentally once webcast a little bit of a trilogue, caused an awful stir. I think that might be quite an interesting process, actually. But I think there's a lot of people that wouldn't agree with it, but I'd be up for it. So again, I've done, because I can't meet people, because I'm a very busy person as chair, literally, I have to sit through hours and hours of things chairing, and I can't see a lobbyist when I'm 4 hours in a trialogue. So where I'm a rapporteur on something, I've done a kind of exposure draft of what's going to be in my report, and I will take comments in and be busy tweaking, but also that also gives everybody more time to think about when the general amendment deadline comes round, how they could address themselves to that. So I think there are tools. I have problems with transparency, and I do not know what shadows are discussing on reports. And when it's all fallen apart and gone wrong, I'm the one that's called in to stick it back together again, and they haven't been telling me what's going on. I'm the one that's up before ministers. I'm the one that has to go to ECOFIN and tell everybody what's going on, and they don't bother to I'm not allowed to be in the loop. One way or another, I tend to find out and manage to deal with it, but I'm just saying, the processes are difficult for me, as chair of the committee, to understand sometimes what on earth is going on.
You know, my experience, I don't know if it's the same here as on the other side of the Atlantic, is that elected officials tend to be more receptive to listening to all parties, and the damage gets done more in the bowels of the bureaucracy, where in the case of Dodd-Frank, you've got several hundred different rulemakings being put out, each highly technical, each with the consumer organizations completely outgunned by the industry experts. And so by the time it comes back to elected officials, a lot of seemingly technical but really key decisions have been baked into the cake. Why don't we, it's 5:30, why don't we take 2 more questions, and then let's go off and drink, because we probably need one. Yes. You, sir.
This is a journalist from
Marc Roche of Le Mont. It's just a thing about democracy. Do you think that the jargon use, the technical jargon, the financial jargon, is a big barrier to democracy because no one understands? I mean, an average person participating in all the debates would wonder what you discussed about.
I have a suggestion. It occurred to me when we were looking at Adrian's charts this morning. You remember his chart, which took the large banks and then said, well, if you take away the amount that is clearly linked to the real economy, and then you take out the next piece, you're left with this. And of course, it occurs to you right away that banks, at least of that scale, are no longer banks. And part of the reason the consumers get confused, and part of the reasons the politicians are captured, is because they still think that a bank is sacrosanct and absolutely vital to the economy and have to be protected and will be the source of economic growth. Now, here's the suggestion. If you are in California and you're a winemaker and you want to sell a bottle of Cabernet Sauvignon, it has to have at least 51% of Cabernet Sauvignon grapes in the bottle. So why don't we introduce in Parliament here a motion that says, if you want to have the name bank, you have to have at least 51% of your risks tied up in real economy-related activity. And if you don't, you can't be called a bank. You can be called a financial conglomerate. You can be called a securities broker-dealer. But all of a sudden, I think the image of what we're dealing with would change.
We have tried things similar.
Bob, I thought you were going to say that if you were going to call it Cabernet Sauvignon, it had to be made in France. But that's another debate. One more last question of the day. Sir. Voila, you.
Thank you. Last question maybe for Mr. Jenkins. Auditing about 130 banks seems such a daunting task for the ECB that they are calling Oliver Wyman for help. But Oliver Wyman has not been very harsh in similar situations before, for example, in Portugal. So have you got an opinion about this choice?
I'm sorry, could you rephrase the question?
I'm not sure I understand the question either.
I think
This was
I did.
ECB bringing in
Translate.
Oliver
Yeah,
Wyman.
okay. The private sector firm that has been chosen to assist the ECB in the asset quality review of
Right.
the 130 banks doesn't necessarily have a track record for being one of the harshest in the assessments because it was the one that was used in Portugal. I think is that about
That's the
rough
gist of it, I think.
translation of it? And so what do you think?
Maybe you should address that first.
No comment.
I think it's probably maybe we can once bitten twice shy. I think that the Parliament put a lot of pressure at all levels, both on to ensure that there was going to be private sector involvement at all levels of this review, that it wasn't just going to be that the supervisors did the information and it was internal of the ECB and then there was no access to the raw data. So I think we've got quite good assurances from the ECB and from the Eurogroup that they want a thorough involvement, and it's got to be credible. The credibility of the ECB is on the line here, and they have actually been the one institution that has helped to pull the Eurozone through problems. So there's an awful lot at stake for the ECB and everything else if there isn't credibility. I mean, there are other issues that one is trying to resolve around it. I think transparency is probably pretty key, that as well as the data being looked at privately, that certain things like, well, what are the holdings of the various different sovereign bonds and so forth, we're going to have transparency of those, especially if there's not going to be any risk weighting, and then the markets can do their own assumptions and risk weighting. So this is the direction in which the Parliament is pushing it, and we're very much trying to stay on top of it, and we'll be making life as uncomfortable as possible. Well, I will be until I leave, and then it'll be up to the new Parliament if it's not being done in the right way. And I think that there are so many eyes on it that we just cannot afford that this be not a fully definitive one that resolves issues. We've limped along with substandard ones. The fact that this is very important is why there's been a sort of little bit of a spat going on in which I've become involved with Mario Draghi about, well, what's the role of state aid and all this kind of thing, because it has to be, to have the right treatment, the right confidence, so that this is an end of uncertainty about what is lurking in European banks. And we face up to what the problems are, and then we can begin to move forward. And that's what the US was able to do. And they, of course, also had market support because they've got market funding as well as bank funding to support their economy. We have to move on. And I think that, well, if we don't, there's only one word for it, and that's disaster.
Well, and I would close by adding that the disaster is political as well as economic, that the stakes of getting this right include not just restoring the functionality of the financial system and restoring growth in Europe and in the United States, but in restoring confidence on the part of the people that democracy works. You have right-wing populist parties in Europe. We have the Tea Party in the United States. And so this is not just about the financial system, it's about democracy. I want to thank the panel, and I particularly want to thank Thierry and his team at Finance Watch for a really illuminating day. Thank you.
I will only keep you for 20 seconds. This surely has been a fascinating day. I think we didn't have 1 minute of lost time. It's been really impressive. I want to thank you all, participants, speakers, panelists, moderators. I think you've all done an incredible job in feeding the debate in the spirit that I mentioned this morning. We have drinks now, so please stay with us. There'll be drinks served just outside. Call again, come again. Everything, as you know, was on record and will be on the Finance Watch website. Just give us time to put it there. You know, we need a few days, but you can find track of everything that was said today. You will be able to find track of everything that was said today on our website in the coming days. Thank you very much, and look forward to collaborating with every single one of you in the future. Thank you.